Technical indicators. In this section, we'll talk about technical indicators and how you can use different technical indicators to determine and analyze the movement in stock prices, whether they'll continue the ongoing trend or if there will be a reversal, and so on. With the help of these indicators, you'll be able to make informed decisions on when you should enter or exit the market regarding a particular stock. You do need to keep in mind, though, that technical indicators were designed to analyze short-term price movements and not to analyze fundamental aspects of a business like earnings, profit margins, or revenue. Long-term investors rely more on fundamentals of the company rather than the technical aspect, so you would often notice that technical indicators hold very little to no significant value to these investors. Technical indicators can be further classified into leading or lagging, and let's jump right into that. Leading technical indicators. Active traders use leading indicators to try and determine the future direction of the market, so they can predict market movements ahead of time, ahead of everyone else, and then take a position accordingly. In really simple words, if a leading indicator sends a correct signal to a trader, he or she can anticipate the direction and enter before the market actually starts moving and then ride the entire trend. Now, all this sounds good in theory, but in reality, the future is always uncertain and leading indicators are not 100% accurate. They can be wrong at times, and that's why traders combine leading indicators with other forms and tools of technical analysis to make an informed decision. Lagging technical indicators. A few analysts and traders might consider lagging indicators as a negative tool, but it all really depends on your interpretation of how you use it. Like the name suggests, there is a delay in feedback when you use a lagging indicator, which basically means it sends you a signal once the price has already moved or is in progress. You might not be able to enter a trade at the right time with a lagging indicator, but you can confirm whether the price trend moved as per your assumptions. This is one of the reasons why the lagging indicator is mostly used by trend traders. Lagging indicators won't anticipate the future price movements, but they will give you a confirmation whether a trend is underway. So while this indicator doesn't provide a specific trigger on when you should enter the market, it does give the trader more confidence if and when they're correct with their deductions. Leading versus lagging technical indicators. Now, the most obvious difference between the two indicators is that a leading indicator anticipates the future market movements, while the lagging indicator gives a confirmation to the traders whether their anticipated trends are taking place in the market. Of course, both of the indicators have their own advantages and disadvantages, and we'll discuss in short the differences between how each works so you can make a decision on which indicator suits you best with your strategy. Okay, so you already know how the price of a stock can move really quickly in the market, right? Be it upward or downward. Leading indicators react to the price just as quickly and send signals accordingly, which is great for you if you are a short-term trader. But at the same time, it can also send out false signals. It can only predict the future and not create it. Let's say the indicator sends you a signal to enter the market, but when you do, the trend promptly reverses and a hasty decision can end up as a loss for you. Conversely, lagging indicators with a better sense of accuracy might send you a signal to enter the market, but they're far slower to react, which means you could already be late in entering the market. Both indicators have their pros and cons, and relying solely on just one indicator might end up having a negative effect on your strategy. So that's why you should try to find a balance between the two indicators. Now, there are different types of technical indicators, like a trend indicator, which can anticipate a change in price, or a volatility indicator may form and can inform you about the volatility in the rate of price movement. And we're going to discuss all 4 different types of technical indicators with a few examples. So let's start with our first indicator without any further delay. Trend indicator. As the name suggests, trend indicator measures the direction and the strength of a trend to some extent and establishes a baseline using some form of price averaging. If the price goes above the average, then you can consider that a bullish trend. Similarly, if the price goes below the average, you can think of that as a signal for a bearish trend. There are different types of trend indicators that you might have heard of, such as moving averages, MACD, parabolic, SAR. And let's discuss a few of them now. Moving average convergence divergence, MACD. Although we've discussed MACD in a previous section, we're going to discuss this topic a little bit more in detail now. So what exactly is MACD? Moving average converged divergence, or in short, MACD, is a momentum-based indicator which illustrates the relationship between 2 moving averages of a stock's price. MACD portrays such trend-based indicators into an oscillator by the method of subtraction of a longer moving average from the shorter moving average. This, in conclusion, leads to the calculation of the MACD line. If we observe that the MACD is above the signal line, consequentially, the histogram will be above the MACD's baseline as well. In the same way, if we find that the MACD is below its signal line, then the histogram will be below MACD's baseline as well. To identify if the bullish or bearish momentum is high, we can use the MACD's histogram. Let's understand this further with the help of 2 different charts. Consider this chart here. On the 19th of December in 2018, you can see the MACD line, green. You can see it rise slightly above the signal line, which is red, and that indicates a positive buy signal. This continued till the 20th of January in 2019 with the MACD line dipping below the signal line and eventually below the baseline as well, indicating a sell signal. Here's another example. In the above chart on the 10th of December in 2018, the MACD line dipped below the signal line, indicating a positive sell signal. This continued until the 1st of January of 19 when the MACD line rose slightly above the signal line and fluctuated within small bandwidths. Parabolic SAR. Parabolic SAR is a technical indicator that you can use to determine the price direction of an asset and determine when the price direction is changing. On a chart, you can see the indicator as a series of multiple dots placed above or below the stock price. If you see a dot below, the price is considered to be a bullish signal and it might rise. On the other hand, if you see a dot above the price, well, that means that the market is bearish and the stock price is likely to remain downward. When you see the dots flip, remember that this is an indicator that a potential reversal in price change might happen. So let's say that the dots are above the price, and when they flip below the price, well, that could signal a further increase in price. Then we have momentum indicators. Next on our list, the momentum indicator helps you understand the speed of price movement of a stock by comparing prices over time. It helps you measure the rate at which the price of a specific stock rises or falls. You can calculate this by comparing the most recent closing price of a stock with the previous closing price. The indicator generally appears as a single line below the price chart